Since ancient times, people have shown an obsession to gold. Except for an obvious correction in 2008, gold price has appreciated consistently since 1999, reaching its peak in 2011. After being unpegged with the US dollar, gold price is mainly affected by demand and supply. Therefore, it is important to understand the different factors which can affect gold price before we invest in it. As an investor, Jack wants to diversify his portfolio, so he decides to include gold in his portfolio in order to hedge market risk and inflation. He frequently hears from the news that the Indian festivals and the ETF transactions will affect gold price. So, whenever there is related news, Jack will pay more attention and seek for an opportunity to enter the market. However, Jack has noticed that his strategy is resulting into losses mainly because there are other factors to be considered when investing in gold. First of all, Indian festivals actually have minimal effect on gold price. Traditionally, many people think that Indian festivals have a strong demand for gold, but in reality, the demand is really limited and it does not cause much effect on gold price. Furthermore, the global inventory level of gold in ETF is less than 0.5%. Therefore, any fluctuation on the ETF transactions would only lead to a minimal effect on gold price. In fact, there are 5 more important factors as listed below. 1. US dollar. Since gold is priced in USD, when USD appreciates, gold price will drop correspondingly. Assuming Jack wants to invest in gold, initially 100 USD can only buy 100 ounces of gold. Due to expectation of USD appreciation, we can buy 120 ounces of gold with the same price tomorrow. As a result, the attractiveness of gold will decline today. 2. Inflation. When inflation takes place, the corresponding currency will depreciate. Metals and commodities will then become relatively more valuable. Traditionally, gold seldom depreciates in terms of real value, so it has been used as a tool to hedge the inflation risk. 3. War, natural disasters. When there are wars or natural disasters, people will sell their assets, including local currency, and subsequently buy safe haven assets. With funds flowing to safe haven assets, gold price will conversely appreciate. 4. Economics. When a country enters recession, people will lose confidence in their local currency. Funds will naturally look for risk-averse assets, therefore bringing gold price up. 5. Domestic interest rate. Take USD for example. When the US government raises interest rate, we can earn more interest when we invest in USD. On the other hand, gold as a commodity will not generate any interest. As a result, the attractiveness of gold drops when interest rate rises. Let's say Jack is deciding to invest in USD or gold. If US dollar provides 1% of interest payment per annum but no interest gain in gold, he will naturally invest in USD. Therefore, it is important to understand the different factors which can affect gold price before we invest in it.